Understanding book value and price-to-book ratio is crucial for evaluating a company's financial health and making informed investment decisions. Investors look at book value to assess if a stock is undervalued. For instance, if the market value of the company is below its book value, it might be seen as a bargain, assuming the company's assets are accurately valued. What is book value? Let's look at some of key things to build our understanding. Book value represents the net asset value of a company, calculated as the difference between total assets and total liabilities. This also reflects the value of a company's assets that would remain if the business were to be liquidated and all liabilities paid off. Book value is an important accounting metric used to assess a company's financial strength and underlying value. Calculating the book value of a company is akin to tallying up all the value a company holds after settling its debts. It's not just about numbers, and in fact it's about understanding the fundamental worth of the business. In order to calculate the book value, we need to identify total assets, which are the resources owned by the company that can provide future economic benefits. For example, think cash, inventory, property, and equipment, etc. Then we need to identify total liabilities, which is basically what the company owes. For example, debts, loans, accounts payable, and other financial obligations. Then we calculate the book value by just subtracting all the liabilities from the total assets. This is all about calculating the book value, and let's take a step forward to build an understanding on the interpretation of book value while analyzing a stock. Book value is like the foundation stone in finance, giving a snapshot of a company's net worth as per its balance sheet. Here's why it matters. Like I mentioned earlier, that book value provides insight into a company's underlying asset value, which is crucial for assessing its intrinsic worth. Analyzing book value trends can reveal a company's financial stability and growth potential. Book value is used to calculate the price-to-book ratio, which allows for comparative valuation across companies. Moreover, investors use it to determine if a stock is undervalued. If a company's market value is below its book value, it might signal a bargain. Allows comparison of companies within the same industry. Companies with higher book values are generally seen as more financially stable. Long-term investors look at book value to make informed decisions, especially in value investing. Till now we have seen how to calculate the book value. But now let's try to look at price-to-book value ratio. This is one of the key financial metrics that compares a company's market value to its book value. This ratio compares company's market value, which is current share price, to its book value, which is equivalent to net assets. This ratio is widely used in valuation metric that helps investors assess whether a stock is fairly valued, undervalued, or overvalued. If this ratio is less than 1, it means the stock might be undervalued, selling for less than its assets are worth. If it's more than 1, the stock might be overvalued, selling for more than its assets. If we look at quick interpretation about the price-to-book ratio, a low price-to-book ratio, generally below 1, suggests the stock is trading at a discount to its book value, potentially indicating an undervalued company. When we say undervalued with respect to price-to-book ratio, which means current market price of company is less than the value of the company's assets, suggesting a potential bargain. On the other hand, a high price-to-book ratio, above 1, may signal that the market expects significant future growth from the company. In more simplifying terms, we can say investors are paying more for the company than its book value, possibly due to anticipated future growth or high market sentiment. Lastly, a very high price-to-book ratio, above 3, could also indicate heightened risk or overvaluation of the stock. Profitability. Highly profitable companies tend to have higher price-to-book ratios as the market values their future earning potential. Growth prospects. Stocks of companies with strong growth outlooks often trade at premium valuations, reflected in higher price-to-book ratios. Industry dynamics. Price-to-book ratios can vary significantly across industries based on their capital intensity and growth characteristics. In essence, the price-to-book ratio gives a snapshot of how the market values a company in relation to its book value, offering a lens into perceived profitability and investor sentiment. Quick table on this slide will help for quick interpretation what we have learned so far in this video. Remember, value investors often look for stocks with low price-to-book ratios along with other financial metrics to find potential investment opportunities, believing that the market will eventually recognize the true value of these assets. Let's conclude this video and revisit some of the key takeaways. Book value is a fundamental metric for assessing a company's underlying asset value and financial strength. The price-to-book ratio compares a stock's market price to its book value, providing insights into valuation. Analyzing book value and price-to-book ratio can help investors make more informed investment decisions. But remember, this book value or price-to-book value ratio cannot be used in isolation to make investment decisions, as it doesn't account for intangible assets like brand value or intellectual property, and book values may not reflect current market conditions. Always best to use it alongside other financial metrics for a rounded analysis.